Welcome to Market Call. Thanks very much for joining us. I'm Morella Fernandez. Eric Nuttall on the show today, and he's partner and senior portfolio manager at Ninepoint Partners. He's taking your questions today on energy stocks. Call us toll free, 1-855-326-6266 with your questions. You can email those questions in as well. Market Call at bnnbloomberg.ca. Eric, great to see you. Thanks for coming in. We have some new inflation numbers out. Inflation went down quite a bit. Not a big surprise, but energy gave consumers a really big break. Carbon tax gone.
Yes.
But what else is playing into the lower oil prices? Well,
unfortunately, we have had the oil price be somewhat weak to begin this year. I think there's really two factors that are driving the negativity. One is ongoing uncertainty of the global economy owing to President Trump and his tariffs, just the renegotiation with China or pause. So the market's really struggling with what will the impact on demand growth be, because so far it's been relatively strong. We had Saudi Aramco say that for Q1, demand was up about 1.7 million barrels per day. So that's very strong. Some really leading indicators seem to suggest that that rate of growth is starting to decelerate a little. The second thing that is driving the oil price has been a pivot from members of an OPEC deal and on the cadence to return barrels to a market. So at a time when there's some demand angst, this uncertainty about, okay, what is OPEC plus, the voluntary members of this deal, trying to achieve? And what we've seen is chronic cheating from Kazakhstan and Iraq. I think it's really Saudi Arabia and the UAE that are trying to inflict short-term pain to improve compliance because they've been shouldering the burden of the deal, or at least Saudi Arabia has been. As we look forward at a time, if demand growth weakens and if OPEC continues to add these barrels onto the market, our view is you need to moderate, if not outright stop, short cycle supplies, really U.S. shale. They're going to be the balancing factor. We think that starts at about $60. So at 60, we think shale is flat to slightly down, maybe as much as 500,000 barrels per day. Closer to 50, you lose 1 million. So it really is going to come down to, will demand growth fall? And if it does, then what oil price is required to moderate U.S. shale? If it's a significant sell-off or slowdown in growth, then we need 50. If it's moderate, I think directionally where we trade now is a fair oil price.
Okay, let's talk about natural gas as well, because it dropped, 14% in the latest numbers. And I'm just wondering what you see feeding into that with this whole scenario.
So it's important to have a longer-term perspective on natural gas. We're in the shoulder season now, so when it's not typically hot enough or cold enough for a cooling demand. So the price can be pretty volatile. What we're looking to is we've had a meaningful increase in demand from LNG. The U.S. is exporting now about 16 BCF a day, billion cubic feet. So let's call it 15% of their market. That 16 is growing to about 28 by the end of the decade. So very significant increase in demand. In Canada, the chatter is LNG Canada. We should have our first export next month. I've been on vacation for 3 days, but that was the last rumor that I had. So that's important because it's increasing, obviously, domestic demand for our gas. And importantly, it's going to shrink the discount that we're selling our gas for, just like TMX did for oil. It compressed the differential from 25 to 9. Mm-hmm. The gas discount today is about $2 per MCF. We see that falling to $1.10. And so just assuming normal summer, normal winter, normal weather, the thesis is you have a significant increase in demand from LNG. You have an increase in power demand in the United States. It's going to grow by 25%. And gas has really usurped all other energy forms to satisfy that, because you can't satisfy with solar or wind or nuclear or coal. It's really going to be gas. So you've got the structural increase in demand. And yet when you look at, okay, where will the supply come from to satisfy that demand? It's increasingly from more marginal basins that have a higher cost. And so we think gas will trade roughly $4 to $5 over the next year, depending on the severity of summer and winter. And so at $4 to $5 in MCF, that's up from roughly $3.20 right now. That's a very profitable area for gas producers, especially in Canada, as we shrink the discount for our gas once LNG Canada comes online.
Got it. Okay, a lot to unpack there. Eric Nuttall's going to stick around. He's partner and senior portfolio manager, Ninepoint Partners. Today he's taking your questions on energy stocks. We'll line them up. We're back in a moment. Welcome back. We're going to start with an email right now coming from Luke in Montreal. He says, which Canadian ONG, oil and gas producers, are less impacted by actual tariffs? It sounds like a simple question, but I'm sure it's a much more complicated answer than that.
Well, there's not really major tariffs applied to the sector. We've been very, very vocal to say that all energy would be exempt because it would be massively inflationary for Donald Trump. If they import in 3 million barrels per day of Canadian oil into the Chicago area with no substitute, et cetera. The impact that we're seeing, it's more in the U.S. than in Canada because of tariffs on steel. We're seeing about a 10% inflationary impact on tubulars. So when you think about drilling a well and a lot of drill pipe and such, you're consuming consuming a lot of steel. We've seen that trickle through. I've yet to hear of a major impact from Canadian producers on tariffs. So it's actually a fairly easy topic to address.
And it sounds like that's not going to change from what we know right now.
Yeah. We've been very public on this since the time of inauguration. There was zero logic. The U.S. very much requires Canadian energy, both natural gas and oil, more so for the oil. The refineries are literally geared to process it. They need the products that Canadian heavy oil generates as opposed to U.S. oil, which is relatively light. So we wouldn't expect any tariffs.
You make sense, but some things don't always make sense when you follow through in the U.S. All right, let's go back to an email. Stu has written in. He says, may I please have Eric's opinion on Headwater exploration? Headwater.
Yeah, Headwater is a really high quality, I'm going to call it a small cap company with a market cap of about $1.5 billion. A Clearwater exposure, they've had really good success with water flood. So you just inject water, you maintain pressure, it makes the production stay flat for really economically low cost. We have them yielding 7%. That's sustainable down to 50-ish. That's kind of the marker for most of the sector. So it's kind of a theme where you get paid to wait. We're neutral to bearish on oil, just on the very short term. This is like a nine-ish month call. We just think the market has to absorb some of the OPEC barrels coming to the market. They are less than the headline suggests, but there are still actual physical barrels coming on to the market, which is loosening things. And we're seeing global inventories rise in the past couple of months. So we're just more cautious on oil versus gas. But if you're looking for a high quality, debt-free, high-yield company, get paid to wait, this is a good name to own. We don't own it in our main fund. We own it in our income fund.
How long do you think it'll take the OPEC thing to unwind? I know I'm asking for sort of a crystal ball, but
I'd say about a year. If you look at the headline, it's roughly 2.2 million barrels per day. That is not real because most of the countries involved in that deal have been cheating. We think there's about a million-ish barrels per day to be absorbed. And if you look at the most recent export data from OPEC relative to their high watermark, it's only a 2 million barrel differential. So when we talk about all this spare capacity to absorb, we're really talking 2 million. You don't have to absorb all of that either. So the market's there's no reason to be as bearish as sentiment is currently. Everyone's forecasting stock builds over the next year. It just comes down to a couple of variables that I think people can't have confidence in because, to your point, we have politics at play. There's not always logic involved in that. And we're all kind of struggling to see, okay, what is the actual end game on tariffs? And then we can deduce what's the impact on global demand. I can talk to shale. I can talk about break-evens and what those producers are doing. OPEC we can talk to, but demand is kind of that big unknown, which I think is the biggest struggle that the oil market has right now.
Got it. Okay, let's go to the phone line. JC on the line from North Bay in Ontario. Hi, JC.
Hi, I'd like to ask about Athabasca Oil. It had a nice pop on the MEG news. Assuming the MEG deal does go through at a hopefully higher premium, would you recommend rolling the money into something like Athabasca with kind of that backstop of a takeover potential?
You bet. I think we'll be talking MEG later on, so I'll save my ammunition for that. Athabasca has benefited. What I think you're seeing is our thesis that the strategic value of the Canadian oil sands has been looked over for far too long. There are very few companies that have the reserve base at a time when the twilight of U.S. shale is upon us. U.S. shale companies have a massive inventory challenge. We think the demand for oil will grow for many, many years to come. And in aggregate, most areas in the world are going to be in decline in the next couple of years. The value, strategic value of the Canadian oil sands is massive. And Athabasca and MEG and our larger cap companies have a massively strategic position in the world. We view Athabasca as having well over 50 years of stay-flat inventory, no debt on their balance sheet, low to no growth, buying back as much stock as free cash flow allows. And now you've got a bit of a takeout premium embedded in the share price. At $70 oil, we'd have the stock trading at about 11% free cash flow yield. That shrinks because a lot of these companies have leverage to this. So if you thought we were in a 60 forever world, you wouldn't own many of these stocks. If instead you agree with me, this is just a short-term speed bump to get past, you must use a higher oil price when figuring out the fair value of a company like an Athabasca or a MEG. We still very much believe in $80 or higher, in a year and a half's time from now. So we own it in the fund. It'd be about a 7.5% weight for us. We think the management team has been doing an exceptional job over the past couple of years. So if you're neutral to bullish oil, this is a really good entity to ride.
Got it. Okay, let's go back to the phone lines then. We have another caller on the line, John from London, Ontario. Hi, John.
Hi, Marilla. Hello, Eric. I've been involved in 4 mergers recently, Eric. Exxon bought Pioneer, did well. Chord bought Enerplus, didn't do well. You mentioned MEG, and now Varen and Whitecap have merged. Is that promising? Am I correct? Thanks very much.
Yeah, so we have huge positions in both MEG, and we had a massive position in Varen when it was taken out. Kind of regard Varen as being stolen by Whitecap. So on the pro forma entity, it speaks well to the value that they have. We were very excited about the asset base that Varen had and their ability to unlock value over a drilling program in the near term. So anyways, that's in the past. It's the pro forma entity. We like it quite a bit. We don't own it in the main fund today just because of our views on oil. We're a little neutral in the very short term. Again, we're way more weighted towards natural gas, about 75%. We see massive value in Whitecap stock. We think the team, again, they stole an asset. They were acquisitive in the past. I don't see their need to. That was one of the biggest holdups that we've had in the past, is we felt that they would be acquisitive. They would issue paper and it would be an overhang on the share price. Given the combination going forward, we think that inventory is completely fine with several decades worth of stay flat now. You're getting paid an 8.6% dividend yield, which to me is unbelievably attractive. Again, sustainable down to the low 50s. If they cut, they're growing 3%. So if you cut the growth capex, they can sustain that dividend very, very easily. And so we see meaningful upside. Even at $60 oil next year, once on a pro forma basis, it's trading at 4 times cash flow. And when you look at it now as a larger company, larger index weight, more on the radar screen of larger institutions, I do believe in the concept of a multiple expansion over time, or on the dividend yield, a dividend yield contraction, which means that the share price we think is meaningfully mispriced. At $70 oil, 5 multiple, we get about $14 per share.
Okay, and it's at 8.49 sitting right now. Okay, good to know. We do have to take a quick break. Eric Nuttall sticking around, partner, senior portfolio manager, Ninepoint Partners, taking your questions today on energy stocks. Here's how to reach us. We're back in a moment. Welcome back, and thanks again for joining us on Market Call. Let's go right to the phone lines. Alan's on the line from Guelph in Ontario with his question today for Eric. Hi, Alan.
Hello. Good afternoon. I want to talk about the elephant in the room. Everybody's beating around the bush, but let's get to it. Let's talk about MEG Energy.
You bet.
Okay, thanks for the question.
So here we get the second hostile bid in 10 years, same company. Adam Waterous with Strathcona launches it before a long weekend. Thank you, Adam. Made it things busy. We are opposed to this deal. We think that the bid is laughable. Like they bid 9 point something % premium. It massively undervalues the asset. I have a lot of respect for Adam Waterous and his team and the job they've done of making countercyclical acquisitions. I just want their next countercyclical acquisition to be my major holding. MEG is such a unique story. You've got, I'm going to call it a single asset, super high quality oil sand asset, modest growth over time. So they're abiding by the playbook, and they're using all free cash flow to buy back their stock. We're bullish on oil. Let's call it over the medium term. So let's just run with 70. At $70, even at the current share price after the move, they could buy back over half of their stock over the next 5 years. And so it's really about the value of those remaining shares year after year after year becoming more valuable. Strathcona has done a great job of buying higher cost assets, because I think Adam is a very large oil bull, as I am as well. But what that means is that it would be dilutive to the asset quality of MEG. The quality of Strathcona's resource is not nearly as good as MEG when you look at things like SOR and different attributes. And so as a MEG shareholder, what am I getting? I'm getting less liquidity. I'm getting less quality inventory. Management team, both fine. I liked Darlene at MEG quite a bit. She's been extremely shareholder friendly. So I don't, usually when it comes to M&A, there's a problem that's being solved. Usually it's either balance sheet or poor inventory. MEG has both of those, a very strong balance sheet and exceptionally high inventory. So other than an outright, 9 point whatever % premium, when the stock's clearly trading above that, what's in it for me? when I have assurance, I believe, in the long-term value of this company and the stock just from the compounding impact of meaningful share buybacks. And so, unfortunately, once a process like this starts, assuming that they actually do get a bid, because right now it's just the anticipation of...
They've got a 2-week waiting period before they get it in front of them.
And it's hard to get the genie back in the bottle.
Yeah.
And so, unfortunately, I would be very sad to see this stock sold, this company sold at, I'm going to call it a bottom of the cycle pricing. The fair value of this stock is meaningfully higher than where it is trading now. And so I would implore people watching to take the long term in view and don't trip over pennies on your way to dollars, I think. I think we can make a lot more money as a shareholder just through meaningful share buybacks compounded over time. If we don't get our way, my anticipation would be the quality of this asset is so exceptional that there will be multiple different parties that will have an interest in it. And so is this the time for strategic alternatives for a company with a very strong balance sheet and one of the highest quality assets in Canada that's buying back stock every day? No. But if we don't get our way, then what we would anticipate is the stock will transact at a meaningfully higher price. I'm not going to say what that price is.
Okay. I asked Adam Waters on Friday. We spoke to him on Friday, and I asked him.
What did he say?
Well, I said, "Do you see it as a modest bid?" Which is what people are talking about. And he defended where they came in at. I mean, that's what he's there to do. And
you never come in with your best bid.
Yeah.
And so other than what are they bringing to the table, the ability to fire a lot of people and cut costs, great. Other than that, it's dilutive on almost every other aspect. We remain large as shareholders. I think we're a top 5-ish shareholder of MEG. And I think there's dramatically higher long-term value in this company. And, Adam's not a buyback guy. He's a growth guy because he's an oil bull, as am I. It's two different paths to achieving the same result, which is making money. I just have a way higher assurance that the compounding impact of meaningful share buybacks over time will get me to that destination. And so will a Cenovus step in? I would almost guarantee you that they had a busy weekend. Will an Imperial step in? Will a ConocoPhillips? Well, there are multiple parties that I think will come to the table. In my opinion, this will not sell at the bid of last
week, 2 weeks coming. Okay, Let's go back to the phone lines then. John's on the line from Toronto. His question today is what, John? What's your question?
Yeah, hi, Marella. This is for you, Marella. I missed your introduction to BNN, so I don't know your background, but as a retired teacher, I'd sure give you an A+. You're just doing an excellent job.
Thank you very much.
I appreciate the work you're doing. Eric, I need a gas stock. I believe in the future of gas for sure. Tourmaline keeps coming up, and I know they have a strong CEO and, good growth, so hopefully the dividend will go up. So I just want your story on Tourmaline. Thanks, Eric.
So we're long-term gas bulls because gas has gone from being a bridge fuel to the fuel of not just the future, but of now. We've talked about LNG. We've talked about the increase in power consumption, all these different things. And so where do you want exposure? We've got about a 5% weight in Tourmaline, only because we've run out of other stocks to buy. It's one of our less favorite gas names. Everything that John said is accurate. CEO is very well regarded. They've got good inventory. They've got a high dividend at the time. What they've shown in the past is the words discipline is thrown around a lot. They've been more keen to grow through the drill bit, even through down cycles of the gas price, instead of stop drilling, just buy back shares, which they don't do, and let the market rebalance a lot faster. And so we think there are better names. With that said, obviously, we do own quite a bit at the moment. Our preference is I'll come up with two, actually, as top picks later on, where we just see less drill bit growth, more actual share buybacks. Tourmaline has always been more about dividends, both base and variable. And they continue to be very acquisitive. They made 2 or 3 acquisitions just in the last quarter. So it's just using their stock yet again. It creates more overhang, and it doesn't allow the share price to perform as well. And as a result, they've been lagging, I think, most of their natural gas peers. If I had time, I'd pull it up. But I would say they're lagging their U.S. peers for sure year to date, and a lot of their Canadian peers, because I think it's this incessant issuance of stock to do acquisitions because they're long-term bulls and they're locking up the basin and all that stuff. But it just creates this constant overhang. And as a shareholder, it leads to chronic underperformance, as the stock has been doing.
Got it. Okay, we do want to get to one more phone call before we have to take a break. Michael's on the line from Vancouver. Hi, Michael.
Hello, Marilla. Hello, Eric.
Hi, Michael.
Thank you so much for taking my call. I appreciate it.
You bet.
Eric, I think about a year ago, you recommended Freehold Royalties. And I just wondered if that's still in your portfolio and if you still like it, or if things changed to turn you off on that stock. And if I just had a moment, Eric, you usually talk about the level and quality of management and the quality of assets. Do you ever make a decision to buy something strictly because it is way underpriced, even though you don't like the management and the asset?
No, I don't. So and I've been doing this long enough. If you buy junk, it always comes and bites you in the behind eventually. Okay. You know, bad asset or bad management team, neither of which you get with Freehold. So Freehold, I've sold it to the story as it's a very boring, low risk, low vol name with not a lot of upside, but the reason why we owned it in an income fund, and I own a lot of it personally, is it's yielding an 8.8% dividend yield right now, which is sustainable down to $50, and you get long-term upside from the oil price, the gas price, and last quarter they actually had quite a good quarter. What they showed is that volumes in their U.S. assets, namely the Permian, are growing more than people thought that they would, and so this isn't a name to get rich overnight, but as a lower volatility, less risky name because they don't have drill bit risk. Companies are basically paying them to drill on their land for a fee. You're getting a very, very sustainable yield, and it trades at half the multiple of Prairie Sky. And you know, it's not as, in terms of assets and growth potential, it's not as good, but my God, that's a heck of a chasm. Like, it's trading in line with mid-cap traditional oil companies. Oil companies in the olden days used to always trade at a material premium, and it's not. So we do think the stock is mispriced. We own it really for the dividend income.
Got it. Okay, we do have to take a quick break. We're going to take a look at Eric's past picks when we come back. Stay tuned for that. Welcome back. Time now to share Eric's past picks from May 23rd of last year. We'll take a look at the first one, which was Peyto Energy. At the time, it was recommended $4.62. It's down to $2.34 at this point, or 49% drop, 48% total return drop. Anything specific to Peyto Energy, or is it just caught up in the whole swing?
It's really the oil price.
Yeah.
This is a company where the asset base is highly susceptible to a sell-off in the oil price, which we've had over the past year. We sold this position at around $4 for our fund. This is a name that at $70 and higher, it will do exceptionally well. At 60, not so much. Like, to quantify that, at $60 oil, we have it having a free cash flow yield of 1% now. So they're generating just enough cash flow to drill to sustain production. And, you know, they could buy back 1% of the stock kind of thing. So very boring. At 70, that goes to almost 25%. So it's massive leverage to the oil price. This is a name, you know, I would revisit down the road once we become a little more constructive on oil. I can't fathom how we get back to $70 without a geopolitical event over the next year, because as OPEC is returning barrels, as demand seems to be moderate, the growth rate is moderating a little. You've got to balance the market somehow. So it's going to be moderating U.S. shale, which at 70, you're back into growth mode. Modest growth, but still growth. And so that's why I think we need 60 or lower. This name generates, you know, they'll make it through, they will survive, but there's very limited upside to the equity at $60 oil. Got it.
Okay, let's get to your next past pick from May of last year, Precision Drilling on the TSX. At that point, it was 95.02, and now down to 59.95. So a 37% drop return, 37% dropped return. Anything specific Precision Drilling that's going on?
Yeah, so we sold Precision Drilling meaningfully higher, I think in the high 80s, low 90s. It's obviously susceptible to the sell-off in the oil price, because the oil price sells off. Shale companies go, okay, we've got to lay down rigs. Precision Drilling is the owner of those rigs. So you're in an environment now where activity levels are falling. We would expect if we stay at 60 and lower, the rig count's going to fall by anywhere from 40 to maybe 50 rigs or higher from now to the end of this year, meaning production will fall. So it's good for the macro, not so good for Precision, because that means that utilization is falling and pricing is going to be falling as well. Coming into this, you know, we've got the stock now at a 28% free cash flow yield. I would say my confidence of that number is very low, because everybody's struggling to see, okay, you know, your uncontracted rigs, obviously pricing's going to be falling. This would be, again, if you're more constructive on oil, because there's gas activity, but oil is going to move the needle in the short term for these guys. This would be a name to revisit in maybe 6 months' time once the market's absorbed more OPEC barrels.
Got it. Okay, let's get to your last pick from May of last year, which is ARC Resources. ARC at the time was 25.06. now to 29.09, 17% upside, 20% upside in total return. So how have they bucked the trend?
Yeah, so you see the difference in performance to the product. So oil is down, oil stocks have just been shellacked. Gas, I would say flat. Gas names have done very well. I think you've seen a lot of rotation out of oil into natural gas. Just the short-term macro is significantly better. We've touched on the reasons why earlier in the show. ARC also bought some assets from Strathcona, which is partially funding, hopefully, an unsuccessful MEG bid. We have it accretive by about 6%. Others have it about 10%.
Okay.
What we like about ARC is you get decades worth of super high quality inventory, an exceptionally strong management and board that has been buying back stock. I think this is year 2 or 3 where we're getting all of the free cash flow in the form of buybacks. And so they've got the asset base to allow for that. And so they will be a huge beneficiary of the compounding impact of meaningful share buybacks over time.
Got it. Okay, we are going to leave it there and take a quick break. We're going to line up some more phone calls for Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. We're back in a moment. Welcome back, and thanks again for joining us. Let's go right to your phone calls. Andrew is holding on the line from Edmonton today. Hi, Andrew.
Andrew?
All right, we'll give him one more shout out. Andrew, you there? Okay, I think his question was from Peyto. We'll ask his question for him if you can just sort of give us the outline on Peyto.
Yeah, I like Peyto a lot. It's done very, very well. It hit a 52-week high mid last week or so. I'm still in vacation mode from the long weekend, but what you're getting is really good deep basin exposure. So natural gas, we're bulls on natural gas, thinking we'll see 4 to 5 and we'll stay there-ish over the next many years to come. This is a stock where they did a really great acquisition from Repsol mid last year. It was kind of hand-in-glove asset overlap. It turns out Repsol wasn't doing a spectacular job, so Peyto's been drilling on that land. They've done an awesome job in grinding down costs. At the time of that acquisition, they also hedged out the natural gas to ensure that they weren't taking on too much risk at the time for the next couple of years. So you're getting meaningful upside. You're getting downside protection owing to their hedges. You're getting paid now 6.9% yield now, which we have sustainable down to 2.75. So very good dividend yield, kind of thematic for the sector. And what we see is as they delever and pay down debt, at some point next year, we think around June-ish, so call it this time next year, we're going to get a dividend increase. And they've kind of teasing us in terms of how much that is. I think the word they've been using is meaningful if they're going to do it. So we could see a 20% or more dividend increase. So what you think is a 7% now could be, over 8. So if you're getting paid to wait, you're getting the benefit of strong gas prices now. Once we get into the actual weather, once it becomes hot enough for cooling, we expect the gas price to increase. LNG Canada is a catalyst for it. So there's a lot to like in Peyto.
Got it. All right, good one to look at right now for down the road. Let's go back to Paul from Orangeville, Ontario, on the line right now. Hi, Paul. What's your question?
Yeah, Vermilion Energy. What's the real situation at the moment, and is there any possibility for upside, or is it better to get out?
I think you'll like life a lot better if you just sell the name, crystallize, I'm guessing, a loss. A few people are making money on it now, and just move on to better names. We've talked about a whole bunch. If you want a yield, I think Whitecap, you're getting bigger asset base, better management team, way higher yield, better balance sheet. There's no thesis to this name whatsoever. They're pivoting kind of from international, where I've talked about if you need an atlas to know where their different bases are, because they were like scattered all over the planet, you just can't be focused. The CEO probably is super elite status for the rest of his lifetime with all the traveling he would have to do. And so it just lends itself to poor execution, which I think we've seen. They're now pivoting back to more marginal assets in the Montney in Northeast BC. I just don't see why you would own this stock.
Okay, so cut your losses if you're there.
Yeah.
Got it. All right, let's go back to the phone lines. Frank's on the line from Mississauga, Ontario. Hi, Frank.
Hi, thanks for taking my call, Eric.
Hi, Frank.
I've been around for a while, and I have seen this narrative set every 5 years. They change the story. One year, the story becomes we're going to run out of oil, and then a few years down, we don't have, we'll have too much oil.
Right.
And the price is going up and down in a wave, and it stays 50 to 75, 80-ish range. And the drum rolls begins when the price of the oil is around 70, 75, and everybody says buy. Instead of, when the price is low, then we buy. So
right.
as a small investor, why shouldn't I be leveraging, the downturn in the oil price right now and buying these stocks like CNQ or the BTE and all that? Because I personally don't believe we're going to run out of oil, and we're going to use oil.
I agree.
Okay.
So I'm
Thanks
biased.
For the question. Go ahead.
I do run an energy fund. I do think the sector is very attractively priced. I do think there's more upside in the short term in gas versus oil, which is why we don't own CNQ right now. CNQ is an exceptionally well-run company. I've talked about this many, many times in the past. You've got Murray Edwards and their team, super high quality. You've got a very deep resource base. You've got, in terms of the global super majors, we do think the value of the oil sands is only going up in time because of the strategic value. It's going to be one of the only basins in the world that has the ability to meaningfully grow and has satisfied demand growth. This is cyclical, and so we're in a down cycle right now. I do think we're approaching the lows of it. We just have a little more time to wait, and so hence why we've got a way higher weight in natural gas. You do get some gas with CNQ, but it's more of an oil story, and so that's the reason why we don't own it. But if you're looking for a 5.5% yield, very strong balance sheet, they're paying down debt from a counter-cyclical acquisition, which they've been extremely skilled at doing. You do get paid to wait. There are other names with a higher yield, which has that same mantra as well. But for a large cap defensive name, which has been massively sold off this year because of the Sell Canada, and then also the tariff concerns and obviously those are in the distant past, we see very meaningful upside in the name. It's just a question of timing.
Got it. Okay, let's get to one more caller before we have to take a break. Greg on the line from Toronto. Hi, Greg.
Hi, good afternoon, Eric and Laurel. Eric, the drillers pulled back pretty heavily. I own some Ensign and noticed Fairfax has a passive position in it now. I recall when Murray Edwards was buying this thing for 22 cents. And
right.
I guess my question is this just a stranded asset in this type of market? And
yes.
Why would Murray Edwards continue to be involved? And any possibility that someone like a Fairfax may like to own a larger position?
Yeah.
It just seems inconsistent with the size and how well this asset is done.
Yeah, so it's a small cap company which struggles at a time when sentiment remains very challenged. It's not big enough to hit the radar screens. We are seeing, unfortunately, M&A. We've had one and hopefully not a second name stolen from us over the past couple of months because companies are taking advantage of distressed valuations. We're seeing it. Thematically, service stocks are hugely challenged over the short term. There's just massive headwinds, especially those with a lot of debt. I would never make M&A part of my investment thesis hoping that they get bought out, because if they get bought out, usually there's a problem, either misvaluation or a balance sheet issue, and Ensign does have leverage to deal with. I'm struggling to see how you're going to make some of your money back in the short term on this one.
Got it. Okay, we do have to take another quick break. We're going to line up some more phone calls and some emails for Eric. I'll last for this hour, but we'll be back in just a moment. Welcome back. Let's go to Jack on the line from Montebello in Quebec. Hi, Jack.
Hi.
Go ahead.
Hey, Jack.
Hi, Eric. Thanks for taking my call.
You bet.
My question is on Chord Energy. I bought it after they took over Enerplus, and it's been a dog ever since. It hangs around $100, and the analysts have it up around $150. So what do you think?
Yeah, we were tempted not that long ago. You've got to appreciate, so if you look at the TSX, so Toronto Stock Exchange, energy is a fairly significant sector. In the United States, it's not. Energy, last time I checked, is about 4% of the total U.S. market. So it's very, very small and largely irrelevant. So at a time when there's worries on demand for oil and people worry about OPEC and what they're doing, et cetera, the appetite for energy stocks in the U.S. is very small. And Chord is a mid-cap company, $5.5 billion market cap. So nobody cares. Nobody's looking. There is value, but you need a sentiment shift, more so in the United States than in Canada. The company's fine. It's got 10 plus years of stay flat inventory. They're in the Bakken. The well results have been decent. They are drilling longer laterals. We've got some consultants suggesting that they would have maybe 4 years of actual high quality inventory left, which is emblematic of the problem that is facing all U.S. shale companies, we think, or almost all. Very positive for the macro. So if you're sitting on a loss, it is a U.S. name. You're not getting paid, you're getting a 5.4 dividend in the U.S. You're not getting the dividend tax credit. I would consider selling it and moving into a name like a Whitecap, where you get a higher dividend. It's more tax efficient. I'm not talking about tax advice, but you get higher dividend yield. You get deeper resource base. You get positive benefits of LNG Canada, because Whitecap has some natural gas. They're drilling good wells. To me, that would be a very good switch.
Okay. Let's go back to the phone lines then. Daniel's on the line from Markham, Ontario, with his question today. Hi, Daniel.
Hi, Morella. Hi, Eric.
Hi, Daniel.
My question is on Imperial Oil, but mostly on Midcap oil sand stocks.
Yeah.
If you had to choose one Midcap oil sand stock, who comes out on top as the best of the rest? Thanks for taking my call.
Okay. Where does Imperial land?
So Imperial is the juggernaut, right?
Okay.
Or one of the juggernauts, $50 billion market cap, not the mid caps. There's only two if you want to talk oil sands, Athabasca and MEG. We own both in size. Again, they're the companies where you've got deep inventory, stay flat-ish models. Both are only modestly growing, and then using residual free cash flow to buy back shares. So in a $70 plus world, these stocks can do phenomenally well, which we see, let's call it 9 months to a year from now. Imperial trades at a massive premium. I don't really understand that. It's not attractive to me on a price to cash flow, EV to cash flow, dividend yield, free cash flow yield. I don't know if it's a harbor of safety that people are using. I would way rather own a C&Q. And if you truly just want the oil exposure, I would consider, MEG is difficult to say now, because let's say Adam Waters pulls his bid, let's just say, or doesn't bid in the company. Well, you're going to go down to low 20s again, unless you get another offer, which is highly possible and I think likely. I would say Athabasca, because you don't have as much of an embedded M&A premium in the share price. You've got no debt. You've got 100% of free cash flow going back to share buybacks. And we see meaningful upside over time. And similar to MEG, where we are not tendering our stock at anywhere remotely close to the current share price, the same is true as Athabasca. These companies are very special. As a guy who looks worldwide, there's very few companies like this. And so we don't want to, wake up to a 10% premium or 9 point whatever when we see meaningful upside in both of those names from here.
Got it. Okay, let's go back to the phone lines. Michael from Montreal with a question. Hi, Michael.
Hi, Marilla. Hi, Eric.
Hi, Michael.
Eric, would it be possible to have your opinion on Cenovus Energy? They recently beat earnings. They raised the dividend as well. Do you see them, like you did mention earlier, that they may acquire MEG, but if they don't acquire MEG, do you see them potentially acquiring Athabasca or Suncor acquiring
I hope not.
Cenovus?
Yeah, so let's deal with Cenovus and then we'll deal with M&A. So what's been plaguing Cenovus? Their downstream, their refineries, which has historically only been 15% of their EBITDA until it started losing money. What they have said is they've made the changes necessary from personnel, they're doing turnarounds, et cetera, that they think they will be able to right the ship and are righting the ship. They had some positive indications from that finally on their quarterly call. They've said it's going to take 2 to 3 years-ish to match the best refining operators, which is great. Upstream, they've always had spectacular quality of assets. They have no mine life depletion issues like a Suncor. So it's really been the downstream issue. This is the story stock for oil. You've got to nail the call, because fair value we think is a lot higher. It's just struggling with when the catalyst is. They've got a turnaround now. I don't think you'll see evidence of downstream improvements until about Q3, enough to get people excited. We like the management team. We like John and his team. We want to be shareholders. It'd be helpful to be a little more bullish on oil in the very short term. But this is a stock which we think will rally once they prove to the market that their downstream operations, the issues are finally behind them.
Got it. Okay, Michael, I hope that helps you. We're going to take a quick break. We are out of time for the phone calls and the emails, but we do have new picks from Eric, and he's going to stick around and give us those when we come back. Welcome back. Time now for new picks with Eric Nuttall. He joins us to share what he's looking at today. His first pick is Expand Energy, NASDAQ, so out of the U.S. Natural gas. How many big players are there in natural gas in the U.S.?
Not many, which is why it's important to be able to, one, pick the appropriate stocks, and two, appreciate that in the United States, there's a bit of a scarcity premium implied on these names. Natural gas, which we're very bullish on, is kind of an extension of the whole AI and data center trade. That's not a major component of why we're bullish. We're really bullish on the build out of LNG, liquefied natural gas, in the U.S. growing from 16 to roughly 28 BCF a day. By the end of the decade, we've got growth in Canada. Expand is large enough, so it's a $27 billion market cap company. So it's large enough for the Fidelities of the world to actually be able to buy. It's the entity, the combination between Chesapeake and Southwestern, where they merged some time ago. And so what we get is over 20 years of stay flat inventory in basins that are closely connected to the LNG facilities in the Gulf Coast. So they get a bit of a pricing advantage. We think that gas will trade between 4 to 5. Others are a little more bullish than us, depending on how the weather shapes up in the summertime, calling for 6. And so their leverage to a rising natural gas price is very, very high. They still trade at a discount to the kind of the front runner of natural gas names, which is EQT in the U.S., which we also own. So we've got about a 10% weight in each EQT and Expand. And so it's large enough to be relevant. Thematically, we're very bullish on natural gas. I still don't think natural gas is well owned by generalist U.S. investors yet. We've got Trump. There was some news today in terms of them striking a deal to allow more pipelines and getting that through Congress. And so it can unlock some of the areas where they are. And over time, as gas price, we emerge out of shoulder season, we go into the summertime, you can get the stock starting to work again as well. Okay, so Expand Energy out of the U.S. Let's go to your next pick, which is NuVista on the TSX Eastern Alberta. And what are you eyeing on, or what are you eyeing at NuVista? Yeah, so this is a really simple thesis. You get meaningful both natural gas exposure over time and condensate. So think of it as an oil. The premium for condensate is very high now. It's used in the oil sands to blend. NuVista is growing their production by 33% between now and the next couple of years. Once they reach that level, they intend to keep plateau production, and they can keep that plateau for 28 years. And so it's very, very deep. We've unfortunately seen M&A in Canada. We've seen Veren. We're going to see MEG. NuVista has assets that we think are worth about $18 to $20 using recent M&A metrics, where Ovintiv, I'm going to call it a U.S. name, came to Canada and they bought Paramount. So if you use similar kind of metrics, you'd get to about $18 to $20. Our view is the real money to be made in this sector is in the wait. It's in patiently waiting for the compounding impact of share buybacks over time, as this company is doing. They're using almost all of the free cash flow to buy back their stock. And so at a constant $4 gas price and $60 to $70 oil, they can buy back 33 to 52% of their stock over the next 5 years while they grow production by 33%. And in, call it 5 years' time, I don't think they'll be around that long, but if they are, they could pay us a 13 to 19% dividend a year per year for 28 years. And so Canadian names with deep inventory at a time when we've got the twilight of U.S. shale, we've got challenge to U.S. growth, and in fact, we think production may be in a terminal decline now, depending on the short-term oil price. The scarcity premium and value and strategic value of these assets, we think, is meaningfully going up. And NuVista is, I think, our second largest weight, and I think we're the second largest shareholder after Jim Riddell of Paramount. And so we've got good company. Got it. Okay, let's get to your last pick for forward-looking, which is Tamarack Valley on the TSX. What do you like about Tamarack? Yeah, so Tamarack is one of 3 oil names that we own out of about 12 holdings. What we like is, even though it's oil weighted, at the current oil price, it's only trading at a 10% free cash flow yield. We are medium-term oil bulls. Even at just at $70 oil, that 10% expands to 17%. Their dividend, which they yield 3.4% now, their dividend plus their ability to keep production flat is sustainable down to $42. So it's one of the lowest break-evens of any company in Canada because of the quality of their assets. They're in one of the most economic plays in North America called the Clearwater. They're also having exceptionally good results from water floods. So you're putting water in, you're keeping reservoir pressure up. You can keep that production up for a very, very competitive cost. And so again, it's the compounding impact of meaningful share buybacks over time, where let's say, we think we'll see $70 again next year. This company can buy back at least half of their stock over the next 5 years. And they've got well over 20 years of stay flat inventory. So it's a similar story and theme to the oil sands, which are just the only other 2 names that we own. We have 3 oil holdings today. It's Tamarack, Athabasca and MEG.
What seems to be the line for oil producers as far as comfort level for price? So we're around 60 now. You mentioned Tamarack could get down to 42 and they'd still be okay.
Yeah.
So what's sort of that mid-range line, do you think, for a lot of the oil producers?
We think it's $51,
okay,
to be exact, too. So that's on average to be able to generate enough cash flow to pay your dividend, because you never ever want to cut your base dividend, and keep production flat. Like, we don't think the sector should be growing now at a time when OPEC is returning barrels to the market. We think that, demand, we'll see what growth shapes out to be this year. Expectations have been coming down. OPEC is returning those barrels, as we've talked about. And so really, shale is going to be the balancing mechanism. Because we only need 51, they really need 60. Below $60, we think shale production falls. And we're starting to see that in real time. And it's gratifying to see the real leaders within shale, whether it's the pioneers or now the Diamondbacks, affirming our view. And that is the twilight of U.S. shale is here. That's massively bullish to the oil price over the medium and long term once we normalize OPEC spare capacity and get past the potential demand funk. So we remain bullish in energy stocks. We're positioned right now more towards natural gas, and we'll evaluate oil as things play out over time.
Got it. Eric Nuttall, good to see you. Thanks for joining us here at the table. That is it for Market Call today. Thanks very much for tuning in. We'll see you again tomorrow.